All right. Good morning, afternoon, evening, night. Depending on what time of the day you are going to be listening to my lectures. This is chapter 5, merchandising operations and the multiple step income statement. Before I go forward, I want to make sure that in the last 4 chapters, you have been able to understand every single concept that was discussed. I don't want you to feel like, oh, I'm done with the test, the exams, and that is it. No. In the next 4 chapters and even more, we are going to be using most of all the concepts we already learned in the last 4 chapters. And so, if you don't understand it, I want you to take that extra step to make sure you understand chapter 3, you understand chapter 4. Um, do the tutorials, jump on the tutorial Zoom calls, um, come through the office hours, and ensure that you are really understanding the materials and the content that is being taught. Again, because we're going to be building on them as we go. Okay? So, with that being said, let us go into chapter 5. So, in this chapter, we have 5 learning objectives. Six, sorry. We're going to be describing merchandising operations and inventory system. We're going to be recording purchases under a perpetual inventory system. We're going to record sales under a perpetual inventory system. We're going to prepare a multiple step income statement and a comprehensive income statement. We're going to determine cost of goods sold under a periodic inventory system. And lastly, we're going to compute and analyze gross profit rate and the profit margin. We may also do a seventh one, which is recording purchases and sales under a periodic inventory system. All right, so let's do this. All right, learning objective 1. All right. So merchandising companies are companies that buy and sell goods to the customers. The merchandising companies buy goods from the wholesaler and sell to the customers. Okay. For example, we have the United Stationaries buying Office Depot buys from them and then sells to us as customers. Now, the primary source of revenue is usually referred to as sales revenue. If it's a service company, it's going to be called service revenue. Okay, so but for a merchandising company, we call it service revenue, sales revenue, or just sales. Okay. How do we measure income for a merchandising company? We begin with our sales, what you sold, right? You less your cost of goods sold. And what is the cost of goods sold? The cost of goods sold is the total cost of merchandise sold during the period. The total cost of that merchandise that you actually sold is called cost of goods sold. And when we deduct our cost of goods sold from our sales revenue, it gives us the gross profit. If your gross profit, your cost of goods sold is more than your sales, then you'll be running at a gross loss. If your cost of goods sold is less than your sales revenue, then you'll be running at a gross profit. And then we deduct our operating expenses. Okay, operating expenses run from rent, insurance, sales and wage, salaries and wages, transportations and stuff like that. Now, if our operating expenses again is more than the gross profit, then that will be a net loss. And if your operating expenses is less than the gross profit, then you're going to be operating at a net income. Our operating cycle for a service company is usually not too much as compared to that of a merchandising company. For the service company, we have they perform the services, you send out your invoice, accounts receivable, and then they get it, they send you the check or their cash in the mail, or however they choose to send it to you. You receive the cash, you perform service, and so it goes in that cycle. Whereas for a merchandising company, it also involves the use of inventory. Okay, so you buy your inventory, you sell, right? Your inventory to your customers, um, accounts receivable maybe because they didn't pay you right and then you receive your money, and then we go back to buying inventory. So that's pretty much the cycle. It's just different from the service company in terms of the inventory that is added. So all merchandising companies deal with inventory. Now, what's the flow of our cost? We begin with our beginning inventory, and we add the cost of goods that we purchased, right? So at the beginning we have an amount, and then maybe that amount is not enough for us to sell within the month, and so we go ahead to buy more. We add them together. That gives us the cost of goods that is available for sale. Out of the goods that is available for sale, right, we're able to sell our goods, right? So that gives us the cost of goods sold. And then whatever we have at the end of the inventory, at the end of the season, is called our ending inventory. So a very quick example would be, for example, I sell pens. I used to use donuts, and my students were like, why do you always use donuts? I want to use pens this time around. Okay. So you bought pens, you sell pens as a business. At the beginning of the period, say you had 10 pens, right? But you usually will sell, say, close to 30 pens in every month. So you go ahead to buy, say, 40 more pens. When we add the 40 pens plus the 10 that you already have, that gives you the cost of good that is available for sale. Okay, at the end of the period, let's say you sold 40 of those pens. What you have left is going to be 10 pens, because you had available 50, you sold 40 of them. What you have left as your ending inventory is going to be 10 pens, right? So companies use a perpetual inventory system or a periodic inventory system to account for their inventory. You always want to be able to keep track of your inventory, so that you for so many reasons, again, so that you are able to know, what your customers buy, what you have left. If somebody is stealing your goods, understanding your ins and out of your inventory, if people are even demanding for such goods. So you always want to keep an inventory system, inventory count. And the only way we can do this through these two systems, which is the perpetual inventory system and the periodic inventory system. So for the perpetual inventory system, the company maintains detailed records of the cost of each inventory purchase and sales. So it's a more detailed system of inventory, whereby for each sale that you make, you are keeping track. For each purchase you make, you are keeping track. You know how much you have on hand per time. All right, maintains inventory records such that inventory that should be on hand is continuously updated. Okay, and determines cost of goods sold each time a sales occurs. So you want to put that at the back of your mind, that under the perpetual inventory system, you are keeping cost of goods sold for each single sale that you make. Now, the periodic inventory system is a company does not keep detailed records of goods on hand. Okay, so we are not keeping detailed records of the goods on hand. What we do is that we try to do this count at the end of the period. So if your end of period is every month, then you're doing your count at the end of the month. If it's quarterly, then you're doing your count at the quarterly. If it's yearly, then you're doing your inventory count at the end of the year. All right, determines cost of goods sold determined by account. Okay, determines cost of goods sold determined by account. So we have to count what we have, and then that way we're able to determine our cost of goods sold. And how do we calculate this cost of goods sold for a periodic inventory system? We know what we have at the beginning. Remember I said we had like 10 pens. Here we have 100,000 we began with. We add our purchases, which was 800, right? We add them together. That gives us the cost of goods that we have available to sell. Now, at the end of the period, we are told that we have 125,000 left. So when we deduct the 125 from the 900, it gives us a cost of goods sold, right? And that cost of goods sold, 775,000. Okay, so that's how we calculate our cost of goods sold in the periodic system, inventory system. What is the advantage of the perpetual system? We've talked about some of them before now. Traditionally used by merchandise with high units of value, right? So places like cars, jewelry stores, furnitures mostly use this. Like they want to keep track of their inventory as they are being sold, right? And it shows quantity and cost of inventory that should be at any point in time. So at any point in time, you know how much you have left. At any point in time, you have an idea of what is left in your inventory and the cost of it. And then it provides you with better control, right, over your inventories, because you don't want people to steal from you. You also want to be able to provide goods to your customers when it is needed. You don't want to have customers coming to the store and they don't have the inventory to buy because you did not keep proper record of your inventory. Okay. All right, so we're going to do this merchandising, operating, and inventory system. Here we are told to indicate whether the following statements are true or false. If false, indicate how to correct the statement. Okay, so the primary source of revenue for a merchandising company results from performing of services. No, that's not true, because we say service revenue is for service companies, and for merchandising we said it is called what? Sales revenue. All right, so number two, the operating cycle of a company is usually shorter than the merchandising. That is true. Sales revenue less cost of goods sold equals gross profit. That's true. Ending inventory plus cost of goods purchased equals cost of goods available for sale. That is false. It's beginning inventory plus cost of goods purchased that gives you the cost of goods that is available for sale. Okay. So we go to learning objective 2, recording purchases under a perpetual system. We're going to be looking at how do we record purchases under a perpetual system. All right, so under the perpetual system, right, it's either made using cash or credit. And we said over and over again that credit also means on account. So once you see the question on account, it means that money was not received at the time that purchase was made. So when we talk about the purchase being made, we're looking at the retailer, the merchandising company buying from the wholesaler. Okay, so normally record when goods are received from the seller. So we usually record it in our system when we receive the goods, right, from the person who sold it to us. Then we have the purchase invoices. Should support each credit sale. So the purchase invoice that you have should support your credit and purchases. And this is an example of what the invoice looks like. The purchase invoice, we have the title of the company we bought from, our names, the person who sold to you, the address, and all that good stuff. We have the description of the item that we bought. We have the terms here. We have shipping point. We're going to talk about this in a minute. And the total amount, which is 3,800, right? All returns must be made. It gives you the condition, important notice, and all that. The invoice number and all that we need to know about the sales or the purchase that we made from our wholesaler. Okay. All right, so this is an example. So this SOC Stereo, the buyer, okay, I'll say the merchandiser, uses as a purchase invoice the sales invoice prepared by PW Audio Supplies Inc. Okay, the seller. Okay, so this person, SOC Stereo, is buying from PW Audio Supplies. Okay, prepare the journal entries for SOC Stereo for the invoice for PW Audio Supply. So back to what we did. I told you that it's going to be a build up. Okay, we can't run away from it. You have to know what to debit and what to credit. So now we bought goods. So when we buy goods, what is the analysis? We received our inventory, right? And it was an account. So because it was an account, that is a liability. Increase in our assets is a debit, and increase in our liabilities is a credit. Okay, so May 4 inventory 3008 we debit because again it's an asset. Increase to our assets. Accounts payable, an increase in accounts payable, it's a credit entry. Okay, so debit inventory and credit accounts payable. Accounts payable because we have not yet paid, right, for that transaction. All right, So freight cost, I told you we're going to get to that in a minute, right? Once we have FOB shipping point, ownership of the goods passes to the buyer, right? When the public carrier accepts the good from the seller. Okay? I want us to take time to really understand this slide because we're going to deal with it as we go down the road. If the buyer pays the freight cost, if the buyer pays for the freight cost, right? The ownership of the goods passes to the buyer the moment the public carrier accepts the goods from the seller. Now, for FOB destination, the seller pays for the goods or for the freight. Ownership passes to the buyer when they receive the goods. So ownership of the good remains until the goods reach the buyer. Okay? So I want us to let that sink into our minds. Freight costs incurred by the seller are an operating cost. So if it's an FOB destination, for the person who sells the goods, that becomes an operating expenses. Okay? Example of freight cost. Assume upon delivery of goods on May 6, Soup Stereo pays public freight company 150 for freight charges. The entries on Sook's book is going to be what? You want to guess? Inventory 150. Now we are, for the sake of perpetual, right? For the sake of the perpetual inventory system, right? Once there's a freight charge, right, that is paid by the buyer, we are adding that to the cost of our inventory. Okay? And our credit is what? Cash. Why cash? Because that's a decrease in our assets. Okay, increase in asset of 150 inventory, decrease in asset cash. Okay. If the freight terms had required PW supplies to pay the freight charges, the entry by PW supplies would be, let's look at the difference. Freight out 150, because that's an expenses to the seller. And we say when there's an increase in expenses, we debit. Okay. Cash 150, because that's a decrease in asset for the seller. Okay. And once the seller incurs the cost for the freight, it is an operating expense for the seller. But in the first case where Sook Stereo is the buyer, we're adding the 150 to the cost of the inventory. Okay, because he bought the inventory, all the amount that it requires or all that it takes for him to get and receive that inventory is added to the cost of inventory. Okay, now we're going to deal with purchase returns and allowances. Purchaser may be dissatisfied because goods are damaged, defective, inferior, or do not meet specifications. I know many of us at different points in time in our lives, we have bought goods that we had to return. And we have returned them for different reasons. It's not good, it's defective, inferior, or just meet your specifications. Now, purchase return. Purchase return, you are returning goods for credit if the sales was made on credit, right? Or for cash refund if the purchase was for cash. Okay, so if you are returning the goods or something that you purchased, you are returning it, right? If you made cash payment, they're giving you cash. And if it is credit, right, you are returning the goods for credit. Okay. Purchase allowance may choose to keep the merchandise if the seller will grant a reduction in the purchase price. Like you go buy something and you feel like it's torn somewhere, or maybe the cloth, the button is missing. You say, okay, you know what, I can buy it if you're going to give me a discount. And because they give you the discount, that discount they're giving to you, or that amount they're taking off, is known as the purchase allowance. Okay, Recording purchase return and allowances. Illustration. Assume Sook Stereo returned goods costing 300 to PW Audio Supplies on May 8th. Okay, so Sook bought goods and he wants to is returning the goods costing 300. Remember, they're giving us what the cost of the goods is. It's 300. All right, to PW Audio Supplies on May 8th. Okay, so what do you think our entry is going to be? Accounts payable 300, because when he bought the goods, he bought it on accounts, right? So that was a credit to our accounts payable. Now that he's returning the goods, right? So it's going to be a reduction in our accounts payable and a reduction in our inventory, which is assets, which is $300. So a reduction in asset 300 because he returned it, and a reduction in accounts payable too because he won't have to pay that $300 because it is a return goods. Okay. Nature of purchase discount. Credit terms may permit buyer to claim a cash discount for prompt payment. So sometimes they give you credit terms and say if you pay within this number of days, then you can have a discount, right? Or yeah, a discount for prompt payment. So advantage is purchaser saves money. So you who is buying the goods, you're saving money because you're paying promptly, and the seller shortens the operating cycle by converting the accounts receivable into cash earlier. Okay, so once they sell to you, they also are eager to get back their money as fast and as quick as possible. When this is done, it benefits the seller. Okay, and then you as a purchaser, you're also saving money. So credit terms may read 2/10 or N30. So it's either saying you're gonna get 2% if you pay within 10 days, 2% if you pay within 10 days. If you don't pay, then you have to pay. You don't get anything, but you have to pay within 30 days. Okay, so most businesses give you 30 days to pay off your pay off when they sell to you on credit. Okay, so common purchase discount we have 2/10. We discussed this already. 2% discount if you pay within 10 days. Otherwise, pay the next 30, right? Due within 30 days. One end of month. So 1% discount if paid within the first day of the next month. Okay, or and net amount due within the first 10 days of next month. Okay, so you want to get familiar with this, what they mean, so that when we have questions that give this to you, you are able to calculate the discount as soon as you see it. All right, so assume Sook Stereo pays the balance due of 3,500, gross income purchase price of 3,800 less purchase return and allowance of 300 on May 14th, the last day of the discount period. Prepare the journal entry Sook Stereo makes on May 14th to record the payment. Okay, so we are first going to calculate what our discount is. We are getting 2% discount from the 3,500. Remember, it was 3,008. We returned 300. So now we're applying the discount not on the 3,008 but on the 3,005 because we already returned 300. Okay, so 3,005 times 2% gives us 70. So 3,005 minus 70 is what we're going to be paying in total as cash. So accounts payable that we owe is 3,005. Inventory is $70 because that's the discount that we receive, and the cash that we are going to pay is 3,430. Okay, so although our accounts payable is 3,005, we have a discount of 70 and a cash payment, which is a reduction, like a reduction in our assets of 3,430. Okay, so 2, if Sook failed to take the discount and instead pay the full amount of 3,500 on June 3rd, what will be the journal entry? All right, so if Sook Stereo failed to take the discount and instead made a full payment of 3,500 on June 3rd, what will the journal entry be? All right, so I see an error over here, so I'm just going to do what is right. So this is supposed to be cash. Okay, and this is going to be 3,500. Okay, all right, so this should be cash and 3,500. Okay, because he didn't take advantage of the discount. Okay, and so it's just direct. A decrease in your accounts payable of 3,005, a decrease in cash because you're paying that out, which is an asset. All right, so this is a summary of the purchasing transaction. On May 4, we have the purchase 3,800. Okay, he returned $300 worth of goods. Okay, May 8th, freight in. Again, we said it's a debit to the inventory. We added to the cost. And then May 4th, he received a discount. So we have a total of 3,580 as our balance for the month. All right, let's try this together. On September 5, De La Hoya Company buys merchandise on account from Junot Diaz Company. The purchase price of the goods is $1,500. On September 8th, De La Hoya returned defective goods with a selling price of $200. Record the transaction on the books of De La Hoya. Okay, so De La Hoya is the buying company. Okay, and they bought from Junot Diaz Company. All right, so we're looking at it from the point of view of the buyer. Okay, and the question tells us to record the transaction in the books of De La Hoya Company. All right, so beginning inventory, they bought it for 1,005. Again, increase in our assets 1,005. A decrease in an increase in our liability 1,005. That gives us a credit. Okay, that's to record the buying of the goods. We're told that they sold the returned goods that cost $200, right? So that's a decrease in our liability, 200, which is a debit, a decrease in assets, which is inventory of 200, and that's why we credit it. Okay, and that's it. Okay. Learning objective 3, recording sales under a perpetual system. So now we're going to be looking at the company selling, the company that is selling. So under a perpetual system, recording sales under a perpetual system, inventory system, sales may be made on credit or for cash. Okay, so sales revenue, like service revenue, is recorded when the performance obligation is satisfied. Performance obligation is satisfied when goods are transferred from the seller to the buyer. Okay, so in this case, we're saying that performance obligation is full once the person who sells the goods is able to get the goods to the buyer. Okay, and usually they will send a sales invoice that supports the credit sale. Okay, a sales invoice should support each credit sale. That's an example of what it looks like with all the information. So this is FOB shipping point, which tells me that the buyer paid for it and the good has transferred to them as soon as it gets into the carrier. Here they have a 2 term, that's 2% if they pay within 10 days. Otherwise, it's going to be what they have to pay within 30 days. Okay. How do you record a sale? So we have 2 different sets of recording. The first is that we're going to record revenue. So accounts receivable because you sold and you not yet received money for it. Then the sales revenue, okay? And then we're going to record the expense. Again, we told you that under the perpetual system, we record or take into cognizance the cost of goods sold with every single sale or purchase. Okay? All right, so here we debit our accounts receivable and credit our sales revenue. Again, increase in assets is a debit and decrease in assets is a credit. And then sales revenue, an increase in sales revenue is a credit. For the expense side, an increase in expenses is debit. A decrease in assets is a credit. Okay, so record sales on account. PW Audio Supply records the sale of 3,800 on May 4 to Sook Stereo on account as follows. The merchandise cost PWC 2,400. So you see we have additional information here whereby we're saying that the cost of the amount they sold, so they sold it for 3,008, but that 3,008 they sold it for, the actual cost of that merchandise is what? 2,400. So first we deal with our sales, which is records our accounts receivable 3,008, our sales revenue 3,008. Okay, so increase in assets and decrease and increase in our sales revenue. Now we're going to record our expenses. The cost of goods sold, which is an expense, is an increase in cost of goods sold, which is 2,400, and a decrease in our assets, right? Inventory, which is 2,400. Okay, I'm hoping that we're understanding. All right, so flip side of purchase return and allowances. Okay, so there are times whereby people return, just like we said. So to the person who is the buyer, there is going to be called purchase return and purchase allowances. Okay, now we have it as sales return and sales allowances when we're looking at it from the point of view of the seller. Okay, so contra revenue account is sales revenue with a debit balance. Okay, so if we have any sales return or sales allowance, we do not touch the sales account. Okay, we do not touch the sales account. We have a different account where we post it to, and that is called a contra revenue account. Okay, and the normal balance for a contra revenue account is gonna be a debit balance. Okay, so sales revenue is not reduced, debited, because it will obscure importance of the sales return and allowance as a percentage of the sale. So that's why we do not debit the sales revenue, because it's gonna make it lose the importance of the sales return and allowance as a percentage of the sales. Okay, and they could distort comparison when we are comparing from one season to another season, or comparing from one company to another company. So we have a contra revenue account, which is a sales and returns allowance account. Okay, so how do we record sales return and allowances? So prepare the entry for PW Audio Supplies that they will make to record the credits for returned goods that had 300 selling price with a $140 cost. So you see that each time we have, for the seller, each time they sell the goods, they tell us what the sales is, and they tell us what it costs them, because for each sale or each purchase is under the perpetual system, we are taking into account what the cost of goods sold. Okay, so these goods were not defective. Okay, so again, we're going to have two sets of entries. The sales return and allowance, which is 300. Again, we do not debit the sales account. We do not debit the sales account. Okay, so the sales and return allowance is debited, and the accounts receivable is credited. Okay, because that's a reduction in our asset. Then we come to the expense side. The inventory is 140, and our cost of goods sold is a reduction in our expenses, which is 140, and an increase in our inventory because the goods was returned back to us. It increased our inventory by 140, and then our cost of goods sold by 140 credit. Okay. So assume the returned goods were defective and had a scrap value of 50. So let's assume that this was a defective good and the scrap value was 50. PW Audio will make the following entries. Okay, so sales return is still going to be 300. Accounts receivable is reduced. It's still going to be a credit of 300, but it's going to be inventory 50. Cost of goods sold is going to be what? 50, because they were defective and they gave us the price or the scrap value of that good, which is 50. Okay. So sales discount offered to customers to promote prompt payment of the balance due. All right, so contra revenue accounts to sales revenue with a normal debit balance. Okay, so we see. All right, so we have our sales revenue 3008. Okay, sales return was 300. Okay, and then we have our sales discount, which is 70. Okay, based on calculations. Okay, which is 70. We did the calculations when we did the purchase aspect of this. So this is what's going to show like in the seller's from the seller's point of view. He's going to record the sale for 3,800. They return to him. They return back to him items. Again, we do not debit the sales revenue account. We debit the sales return, and this sales return and allowance is always a debit balance. It is a contra entry for the sales revenue. All right. So we also have the sales discount account, and that gives us a 70. The net sales is going to be the 3,800 minus 300 minus 70 to give us a net sale of 3,430. All right, so assuming Sook Stereo pays the balance due of 3,005, gross receipt price of 3,008 less the returns on May 14, the last day of the discount. Prepare the journal entry PW Audio Supply makes to record the receipt on May 14. Okay, so now we're looking at it from the seller's point of view. Okay, so we have 3,800 minus the 3,300, that gives us 3,005 times the 2%. The 2% discount because they paid up early. Okay, so we have a cash of 3,430. Then we have a sales discount of 70. Okay, which is all debit because when they paid cash, they received cash of 3,430. The sales discount has a debit account, so that's what they gave. That's 70, and then our credit side, which is accounts receivable, which is 3,005, which shows us that the customer or Sook Stereo has paid off for the goods that he owes, for the amount that he owes, which is 3,500. All right, so another example, do it sales transaction. On September 5, De La Hoya Company buys merchandise on account from Junot Diaz Company. The selling price of the goods is 1,500 and the cost of Diaz Company was 800. On September 8, De La Hoya returned goods with a selling price of 200 and a fair value of 30. Record the sales on the books of Junot Diaz Company. Okay, so again, we are looking at it from the point of view of the sales. The first thing we did was the purchase, looking at it from the point of view of the buyer. Now we are looking at it from the point of view of the seller. How would the seller record this transaction? All right, so like we did before, we have the accounts receivable 1,005. We have the sales revenue 1,500. Okay, that's just, it was bought, they didn't pay, it was bought on account. Right, that's how much. Again, we have two different sets of records to do. The next one is going to be for the expense. Cost of goods sold 800, inventory 800. Okay, so because they are giving out the inventory, it's a reduction on their inventory by 800. The expense for cost of goods sold went up by 800. Okay, on September 5, De La Hoya Company buys blah 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 blah. We're supposed to record the return. Okay, so sales return and allowance $200. Okay, because the company that bought didn't really like it or whatever reason it is, they returned it. So sales return allowance 200. Again, for emphasis sake, you do not debit the sales account. We debit the sales return and allowance account. Okay, and that's also a reduction in the accounts receivable of $200. Okay, because the goods or the items were returned. Then we have the expense side. Inventory will go up because they're giving us back inventory, and we're told that the inventory costs how much? A fair value of 30 and cost of goods sold 30. Okay, a reduction in expenses and an increase in our inventory. Okay, increase in assets debit, a decrease in expense is a credit. All right, so we're going to learn objective 4, prepare a multiple step income statement and a comprehensive income statement. All right, so single income statement subtracts total expenses from the total revenue. All data is classified into two categories. We only have the revenue and the expenses, and that's it. Okay, so we have our revenue, we deduct our expenses, that gives us our net income, and we're done. All right, two reasons for using the simple step format. Company does not realize any profit or income until revenue exceeds total expenses. Okay, form is simple and easy to read. You look at it at a glance, you know what you're reading. This is it, this is it. Okay, so it's simple and it's easy to read. All right, so this is an example of a single step. So we have our net sales. Remember what our net sales consist of. We have our sales, we deduct our returns, and we deduct our discounts, and whatever answer we get, that gives us our net sales. Okay, and then we have our expenses in just one category: cost of goods sold, payroll related expenses, occupancy, general administrative expenses, patronage refunds, and others, income taxes. And they give us our total expenses here, which is 2,519,268. Okay, we see that this is less than the revenue, and that's why we have a net profit of 38,000. The same thing with year two. The same with January. Okay, January. So this is what we have. Okay, so we discovered to have a net income, but it's simple to read, it's simple to understand. Just two categories again: the revenue and the expenses. All right, nature of a multiple step income statement, highlights of income, of net income. Three important line items. We have the gross profit. Okay, we have the income from operating, and then we have the net. This is the component of the multiple step income. It's looking at it, it's more detailed, could be a little bit more complicated compared to the simple step method. So here we have the net income, our cost of goods sold, gross profit. Okay, we calculate our gross profit. Then we have our operating expenses, the total expenses. When we deduct that from our gross profit, it gives us income from operating operations. Okay, and then we have other revenues and gains. Other revenue, we have zero. Other expenses and losses, nothing. Patronage refund, we have some. Income before taxes, that's 5991. So how did we get this? We deducted our total income from other revenues from our income from operations to give us 5991. And then we deduct our income taxes of 21,071 to give us our net income. Okay, so this is divided into different sections, different angles, so that we can see and understand the income statement from a different point of view. I want to just take time to explain other revenues and gains. These are other revenues and gains that come from not the operation of the business. So for example, you were using maybe a set of computer, and you sold the computer. The computer is not what you sell on a regular basis for your business, but because you wanted to buy a better computer, you decided to sell the old one that you have. And when you sold it, maybe you sold it at a gain. That gain you have is recorded under other revenues and gains. All right, so let's assume you sold it at a loss, right? Then it's going to fall under other expenses and losses. Okay, so when we're talking about other revenues and gain, it has nothing to do with the day-to-day operation of the business or what they sell on a regular. All right, so I think they explain it in terms of, so we have our sales like we explained, the gross profit, because we deducted our cost of goods sold from it, and then we have our operating expenses, non-operating expenses. Okay, examples like I said before: revenue and expenses, gain and losses on related to company's main line of operation. So it's not related to their main lines of operation like I explained before. So other examples could include interest revenue, dividend revenue, rent revenue, gains from the sale of properties, plant and equipment. That was the example I gave. Other expenses and losses, interest expense, where you have to pay interest expense, casualty losses, somebody stole from you or stuff like that, and losses on the sales of property, example I gave, and then loss from the strike of employees and suppliers. Okay, and then we have our net income. The comprehensive income statement presents item not included in determination of the net income. So items included in the comprehensive income are either reported in a combined statement of net income and comprehensive income, or in a separate comprehensive income statement. Okay, so this is an example of what that other or comprehensive income looks like. So we have net income, we have other incomes, okay? Unrealized holding gains on investments, net of 400 tax, okay, and that gives us a comprehensive income of 23,800. So this has to do with an investment which they have maybe in another company or in an investment security, and so that is deducted from our net income that we had from the previous slide to give us a comprehensive income. Okay. All right, so this is an example, do it for. The following information is available for Art Center Corps for the year ended December 31st, 2022. Other revenues and gains, 8,000. Other expenses and losses, 3,000. We explained what all of those means. Cost of goods sold, 147,000. Sales revenue, 462,000. Operating expenses, 187,000. Sales discount, 20,000. And other comprehensive income. Okay, prepare a multiple step income statement and comprehensive income statement for Art Center Corps. The company has a tax rate of 25%. Okay, this rate is applied to other income. All right, so this is the question we have, and let's do this together. Remember that we have our title. Okay, you don't always want to forget that title. So we have our sales. Here it's a service revenue of 462,000. We have a sales discount of 20, so that gives us a net sales of 442,000. Okay. Then we have cost of goods sold. We deduct our cost of goods sold to get our gross profit of 295,000. Now we deal with operating expenses. They gave us flat out operating expenses 187,000. We deduct that to get our net income from operations, which is 108,000. Then we have other revenues and gains. We have 8,000. Other expenses and losses, 3,000. That gives us 5,000. So a net of 5,000. So we deducted from our other revenues and gains our other expenses and losses. Okay, and that gives us a net of 5,000. Income before income taxes, we deducted the 5,000, or we added the 5,000 to the 108,000 to give us 113,000. Okay, that's income before income taxes. And then we have income tax expense, 28,250. Okay, that is 25% of our income here. Okay, and when we deduct that, we have 84,000 as our net income. Okay, now to get the comprehensive income, we already have what the comprehensive will look like. Prepare a comprehensive income statement. We already have our net income. Tax rate is 25%. Net income is 84,750. 25% of that. Other expense net of 2,500 income. That gives us 7,500. Okay, so our other comprehensive income is 92,250. Okay. All right, so we go to learning objective 5, costs of goods sold under a periodic inventory system. Okay, so we just finished with perpetual, and I don't want us to get it confused. So this is going to be under the periodic system. And remember, we said that under the periodic system, they only account for the inventory at the end of the accounting period. All right, so no running account of changes in inventory is maintained, ending inventory determined by physical count of the goods. So we get to know our ending inventory when we count our physical goods. Our cost of goods sold is not determined until the end of the period. So like we did in the perpetual, whereby for each sale we have two sets of entry, right, whereby we calculate the accounts receivable and then the sales, and then we come to do the cost of goods sold, and then we deal with the inventory. Okay, so cost of goods sold not determined until the end of the period. All right, how do we calculate our ending cost of goods sold? We have the beginning inventory plus cost of goods purchased. Okay, cost of goods available for sale minus the ending inventory. So once we add up our beginning plus the cost of goods purchased, it gives us cost of goods available. When we deduct our ending inventory, that gives us cost of goods sold. Okay, so cost of goods sold under a periodic system. This is an example. We have our cost of goods sold. So we have inventory January 1, our purchases. We have 325,000. Less purchase returned and allowances. So these are things that you returned you didn't like. We're adding our purchase discount to it. That gives us 17,200. We deduct that from our purchases to get the net purchases. Okay, so here we get the net purchases. Then we're gonna add in our freight. Okay, so if there is freight in, we add it to it. That's 12,200. So we see another difference here, whereby we are adding our freight, right? When the buyer pays for it to the inventory, here we have it as freight in. Okay, that's 12,200. That gives us the cost of goods purchased. The cost of goods purchased is 320,000. We add that to the inventory January 1, and that gives us the cost of goods available for sale of 356,000. Okay, at the end of the period, we have an ending balance of 40,000. When we deduct our inventory 31st ending inventory from the cost of goods that were available for sale, that gives us the cost of goods that were actually sold. Okay, so the only thing that I know we had not really explained up to this point was the purchase, how to get your net purchases. Okay, so I'm just going to go over it again. So we have the purchases. You are deducting your purchase returns and allowances and your purchase discount. Okay, that gave us a total of 17,200. All right, so net purchases is 307,800. Right, then we added our freight in, and I told you again that this is different from what it was when we had the perpetual, whereby in the perpetual we added it to what? The inventory. In the case of the periodic, right, it's added in as freight in. It's going to be a freight in account. Okay, and that gives us the cost of goods purchased. So maybe in an objective test, they could tell you calculate the cost of goods purchased, or they could tell you to calculate the net purchases. Okay, or they tell you to calculate the cost of goods available for sale, or we'll say calculate the cost of goods sold. So you want to have these like memorized and understand this particular slide, just in case you see it in the test, you're able to handle the question. All right, so example, do it 5. Aerosmith Company accounting record shows the following at the end of December 31st, 2022. Purchase discount 3,400. Purchases is 162,500. Ending inventory is 20,000. Freight in is 6,100. Beginning inventory is 18,000. Purchase return and allowance is 5,200. Assuming that Aerosmith Company uses the periodic system, compute the cost of goods purchased and the cost of goods sold. Okay, so let's do it here. Solution, we have the purchases, 162,500. We are deducting our returns and allowances, which is 5,200. If we had a discount, we deduct that too. To give us our freight in, we add it, and that gives us 160,000. Okay, we add all of that together, and that gives us a cost of goods available for sale of 178,000. Okay, ending inventory, we have the question told us is 20. and that will give us our cost of goods sold of 158,000 for our ending cost of goods sold. Cost of goods sold, sorry, not ending inventory, cost of goods sold. Okay. All right, we're going to our last objective, which is learning objective 6, computing and analyzing gross profit rate and profit margin. These are analyses that are so important in a business, okay? May be expressed as a percentage by dividing the amount of gross profit by the net sales. All right, possible causes of decline in rate. So it helps you to know, what are the possible, why that you are declining, and then you'll be able to know like why you are declining. So you see that you're selling products with a lower markup. Okay, so if you're selling product, if you're selling product with a lower markup, that means your cost of goods sold is so, you bought the goods, you sold the goods for $100, but you bought them for 90, right? That means you're selling it for a very low markup. Then increased competition may result in low selling price. So if you have a competitor who is selling also, that also may result in a lowering selling price, because you want to sell at a lower price so that you can increase your sales. Company forced to pay high price to its suppliers without being able to pass that cost to its customer. So if you're buying your items or your inventory from a customer who is selling so high to you, then you may not be able to pass that cost to your customers, and therefore your percentage gross profit rate may be low. And that's why we always have wholesale companies where retailers buy from, because they buy it at a cheaper rate and are able to sell, right, at a good price and make profit to their own customers. Okay, so example of gross profit, how do we calculate it? Gross profit divided by net sales times 100. Okay, so we have it over there. Okay, from depending on the question, so you have your gross profit, you have your net sales, you divide and multiply by 100, gives you what your gross profit is. So we found out that for RE in 2016, they had a higher gross profit rate than they did in 2015, which is pretty good. When we compare it to Dick Sporting Goods, we found that the RIE is doing better than the Dick company. Okay, the gross profit rate often differs across retailers because of differences in the nature of their goods. Okay, but just looking at the numbers, we say Dick is doing well, but we also have to look at the nature of their goods to determine if to look at it more critically, to be able to see if actually Dick's is doing less better than the REIE. All right, so we have the profit margin, measures the percentage of each dollar of sale that results in net income. How do the gross profit rate and profit margin ratio differ? Gross profit rate measures the margin by which selling price exceeds cost of goods sold. Okay, whereas the profit margin ratio measures the extent by which the selling price covers all the expenses, including the expense of the cost of goods sold. Okay, possible cause of decline in the rate may be caused by changes in the amount of operating expenses related to the sales, or amount of other relative items relative to sales. So it's either the operating expenses is becoming too high, or you're beginning to sell, your sales is pretty low. Okay, all right, so gross profit reports the following in the, Rachel Rose Inc. reports the following in its income statement. We have the net sales, the cost of goods sold, operating expenses, income tax expenses, and the net income. We're told to calculate the gross profit rate, and to calculate the gross profit again is your net sales minus the cost of goods sold to get your gross profit, right? And then we divide that by our net sales. So the gross profit divided by the net sales. Okay, and that gives us 50% for 2021, and our gross profit, we get a 50% too. So it's pretty much the same for the 2 years. So our profit margin, we did our net income divided by the sales, and that gives us 22.5. our net profit, which is 20 divided by 120, and that gives us 16. So there was a little bit of decline. No, 2021 we had 16.78, and then in 2022 we have 22.5. 22.5. Okay.